Hi, good afternoon, everyone. Once again, I will try my best to again add some spice into this session because after branchless banking and talking about the culture 4 pillars the lady just spoke about, I think this is going to be one of the very interesting session because digital lending has become a very interesting topic in last couple of months because of lot of other issues, and in last 2 weeks it became kind of a fire because RBI, the finance minister, everyone is talking about digital lending suddenly. In fact, we at ETBFSI wrote a lot of articles specifically on digital lending because we saw a tremendous growth, and every fintech who perhaps could not do well with the wallet shifted to payment. Again, he could not do well with the payment, shifted to credit, and every one is specifically into the credit space. And like some time back, I said that they even started giving loans not to the groom and the bride for the marriage, but also for the person who's going to attend the wedding and wants to buy and shop, right? So that's why the digital lending is a really remarkable topic today. And unfortunately, we do not have Mr. Nitesh Ranjan. In fact, he came here, he waited for some time, but he had to leave because there is some important meeting came up, and he said that he has to leave for that. So unfortunately, we don't have him here. But nonetheless, we have four gentlemen here. I'm sure I will learn a lot from them. So digital lending, scaling up the credit segment with data and AI. So Mr. Bhattacharjee, I will come to you first and would like to learn from you how at your bank you are looking at digital lending right now. How has it benefited you and your bank specifically, when you look at digital lending?
Thank you, Amol, for having me here. And it's always been a pleasure to come to an ET conclave like this. First, let's leave the bank aside for a minute. But having said that, how has the entire environment, scaled up? If you look at it, you rightly pointed out there have been, multiple, you can say, changes which have happened over a period of time in terms of the directions given from the regulator. In fact, now is a stage where we now are almost sure in terms of how the entire space will progress. So it is no more ambiguous to anybody now in terms of how this will progress. There are 2-3 parts of lending. Okay, one is the fund flow, which is there definitely, but the other two pieces which are very critical is underwriting and distribution. Now, these are the two places where digital has come in a very strong way in any lending program. Now, when you're speaking about underwriting, there are things that you do to assess whether the customer is credit worthy or not at some point of time. So the upside that digital gets into this space is certain variables which widen the scope of the lending width. So when I say that, the population which comes under the gambit of lending is widened because there is a lot of additional data which is coming in, which could be acting as alternate variables to create an underwriting model. So this is where the entire interaction through digital by a customer has come into play big time. So for example, with the adoption of different channels on digital, the quality of data which is coming into and flowing into the system and into the models is much superior than what it used to be earlier in terms of the traditional models. Now, traditional underwriting would lean a lot on the credit bureaus. Today, while of course that is still as critical, but there are alternates that are available to widen the scope. And the other thing when I speak about bureaus is, there are situations where you have NTT and which is new to credit, an NTC and, new to credit, and as well as thin file statuses which are there for customers. Now, this is where again these alternate data variables are very helpful. And what essentially this means is today, previously when I used to give a loan to a customer, I used to see his credit bureau, score, maybe some other payable variables in their statements, and therefore used to give the loan. But however, today's date, suppose he doesn't have a score, therefore he doesn't have a credit behavior outlined as of earlier. I still have some information about him in the digital space, which gives me some alternatives to that score. to some extent, and therefore a small credit can be disbursed to him. So that is what is the upside that is coming in terms of digital. So these upsides are all also imbibed in any of our modeling. While we have not moved to a completely digital portfolio as yet, but through certain programs, partnered programs, we have assessed the space. In fact, the space is very, very evolving. And with the direction coming in from RBI, there will be a lot more evolution which will happen now. And consolidations will also happen. So that's where we are.
Okay. Meaningful thoughts. Let me come back to you a little later. But Devendra, let me come to you now. And in fact, Mr. Bhattacharjee spoke about data analytics, and data analytics is part of your role itself. In fact, that's your designation. Devendra, my specific question to you is, since the lenders are using data and analytics far more aggressively, how has underwriting of loans improved by data and analytics, and has the operation cost of lending been reduced?
Okay, I hope I'm audible. Sorry, I'm assuming here that since it's a BFI and BFSI conference, probably some of the jargons, pardon me, I'll be using, which is very specific to banks. And coming back to your question, I think when it comes to underwriting automation and identification of new segments, it makes perfect P&L sense for any organization to work on two fronts, right? One is qualifying more customers. Second is when you qualify, which is expansion of universe. And second is getting better conversion, right? So how do you get both in order? Because both acts towards the cost of acquisition as well as expansion of your revenue stream. And I would not only just talk about Kotak per se as a bank, but predominantly all 5, 6, 7 BFSI private sector banks that I am very close to. We are able to work on both sides. One is getting more and more information from customers. If you look at banking pyramid and you use words like new to bank, new to credit, bank thick, bureau thick, okay? What it means is that if you are a bank thick customer, you have loads of information available to take that call of lending and automating that. Then it comes, okay, if you don't have bank thick, it means customer is not engaged. You may at least have bureau footprint of the customer, which gives you some confidence. Typically for banks, this covers around 50 to 60% of the universe, where either you have information or your partners have information. But I think the differentiator factor is the bottom 40%, which is where probably one organization differs from rest, because that's a large mass of customers. They have contacted with you. There is an expectation that as a bank, I think top of the mind that comes to us when we think about a bank is lending, right? While they also do provide deposit services and investment, but lending, that's an expected hygiene that if I have a lending requirement, you should be able to offer me that. Now, I don't care if you're not collected sufficient information, but I am a director somewhere, I am a regular earner, and you are supposed to figure out and offer me that. That's where analytics do come into play. That's where partners beyond what we know, maybe like PayU, e-commerce giants, telco giants, where you have a consented engagement to identify an alternate information stream and take that decision. So that's pretty much the cycle. Makes a lot of sense because the cost of acquisition through digital is 1/10. Okay, 1/10 of what you otherwise do acquire. Secondly, from the customer experience point of view, the conversion is also 10x. So if you don't take an instant decision versus you take probably even 20 minutes to take a decision, the drop is almost 1/4. If you take a day to take a decision, drop is 1/10. So I think it makes a lot of sense to apply analytics to take digital calls. That's pretty much what I wanted to share.
No, sure. So after taking a banker's view now, let me move to a fintech and then a tech company. So Mayuresh, tell me something about digital. What kind of difference the fintech specifically have made in digital, and how is it shaping up considering all the regulations in and around? considering now the banks, those who are REs, will also kind of look at the compliance structure. What kind of difference do you see is happening specifically with the fintech specifically operating in credit space or digital lending space?
Amol, firstly, thanks for having me here. Delighted to be here. Coming to your specific question, see, fintechs and banks have always had to partner with each other because each one brings a different value prop to the table, right? The banks bring the balance sheet, the fintechs bring the technology and the customer acquisition models. What the regulations have done is, to a large extent, as Topendra said earlier, I think it's made it a lot clearer and there's no ambiguity in terms of who can do what within the ecosystem. And that will actually help in the advancement and growth of the overall digital lending space, right? Fintechs have always, used technology to do things perhaps in a different way or in a more cost-effective way. We heard about the Kotak example. I'll just give you another example which shows, the speed or the efficiency, right? So at PayU, we look at about 25,000 bank statements in a day. If I had to have a human looking at it, I would require a huge building full of underwriters looking at that bank statement. On the other hand, we have an AI ML model which reads the bank statements, right, which is looking at each and every line item in that bank statement, not just looking for a salary credit, say, in the month. And we're looking at the spending pattern, right? Is this someone who's, by the end of the month almost has no money in his bank account? Or is there a lot of payments to, betting sites or gambling sites? Or what's really happening in that account? And this model is learning, right? So every statement that I look at goes into our database. And the next statement that it looks at, the model is smarter than it was 1 minute before. So even now, as we speak, the loan I'm writing right now versus the loan I wrote at the start of this session is actually better. Right. All right. So it actually improves at that pace. And the same thing is therefore used in enhancing even customer experience, right? I mean, if now that I know the bank statement, let's say that I know that this person's salary date is on 7th of the month. That's the cycle which he's following. For whatever reason, this customer had chosen, say, 3rd of the month as his EMI date. And we present, say, the NACH bounces on 3rd because obviously he's not got his salary. Now, in a traditional setup, you would say, oh, the NACH is bounced, let me call this customer, let me, it's a miserable experience for the customer and it's expensive for us, right? On the other hand, if I've seen, my systems have seen saying, every past 3 months, we have seen this customer bounces on the 3rd, and he comes on the 7th and pays by himself. It's what in the industry would call an auto-curing customer. Do I really need to call this customer, or will a simple message do? Can I enhance the customer experience by reminding him saying that this has happened, and therefore make it much more cost-effective for me and a much more pleasant experience for the customer, right? So that's where the tech comes in. Not to say that, banks can't do it. I mean, these days, I think, banks are very, very competent as well. It's just that the pace of innovation and the speed at which some of these things can be implemented by a fintech are faster today.
Right. Noted your points, Mayuresh. When we are talking about tech personnel, let me bring you here and take your perspective. So could you again, highlight few important points in terms of what is it that the banks look for when they want to strengthen their digital lending strategy, and how actually the tech is scaling it up and maybe making bankers more relaxed in terms of risk mitigation or, keeping them, what you can say, giving a confidence to banks that, oh, there won't be any NPAs or something like that.
Yeah, so the first thing that comes to mind with that is that banks typically go through about 4 stages of this journey. First is kind of parts of the bank don't believe that digital is the future, parts do. So they'll take what is the hesitant step in that direction, maybe bring in some product, put it in front and demonstrate to everybody else, yes, there is potential here, yes, it's real, yes, it will work for us. So that's typically the first step. Then they look at it and say, well, this doesn't do everything we want to do. We are more ambitious. And so then we move towards a more custom channel to say that, okay, we'll give an excellent customer experience that will create a competitive edge for us. once that happens, then the next realization is that the back-end systems, the core banking system is still 25 years old. The kind of products you want to sell, it can't do. So then you need to look at modernizing the core banking side, and then maybe simultaneously you start seeing, wow, I'm getting much better data through the digital channels. I'm able to see in real time customer behavior. I'm able to see hotspots. I'm able to see how I can maybe change my marketing plan. And then start saying, okay, there is potential in this data. What can I do with this? And then you move into the data and analytics phase where you're looking at, especially on the distribution side, but also on the underwriting side, how you can use that data. And I think the NPAs, it's a little bit of reality. I mean, that happens. But the ability to get complete visibility of people, to be able to promote the right product to them is extremely critical. And in my opinion, now I'll say where I'm coming from. I worked in banks in 9 countries. I have been a customer of banks in 3 countries. So I can say that there is room to improve in terms of what products are pushed. Like personally, I get personal loan phone calls and messages for 25,000 rupees. I'm like, I banked with you for 15 years. You see my balance. Why do I want a loan for 25,000 rupees? But I think there is a lot of room to improve in that, because if I just think about my own data, you will know where my home loan is from. You can then figure out what the interest rate is. You know when your interest rates are now lower than that. You should be able to call and say, hey, balance transfer. But that does not happen, right? So I think there is a lot of room to improve on being more precise in who you target, and that should have an effect on NPAs as well.
Right. Notable points, Prasanna. So since we are talking about data, and the next credit cycle will be based on data, the future of credit will be based on data and AI. The important question I have, to both of you, in fact, Mr. Bhattacharjee and Devendra, is how are you obtaining data? What makes you so confident about data? How do you build accuracy over data? And how do you actually also, apart from this, maintain the privacy of data?
Sure. Can I take 1 minute to respond to something that you mentioned? So, Prasanna, I completely agree with you, okay? And you have to also understand, since you have been banking with banking in 3 countries, you would know how banks operate by now, right? And you have been working with banks as well. So, every bank so far had, different business-wise conversations. So, within the bank, there are multiple banks, and each bank has a system of its own. And therefore, each of those systems have data housed in that space. So your savings account data is definitely not visible to the data of the at the business level from the personal loans perspective. So the first key element that is now moving towards, and I hear multiple of my bank colleagues working around, is harmonizing this data. And that is step 1. I understand that we have been living in a particular way. That's not wrong. But having said that, that is the way the world was at that point of time. And of course, the tech interventions that are available today was not available at that time. So the cost of storage of data, you would agree, has changed manyfold in today's date, right? And therefore, the movement towards, harmonizing this data. Otherwise, we had boxes. Everybody's worked on boxes, right? So now that will change a lot of things. And of course, you compare, a 25, 30-year-old bank to a bank experience to a 2-year-old fintech experience. It will not be the same, because the way in which the fintech has been bred, which is more, data native, cloud native, and the structure, the tech native platform, is very different from what an evolution has happened in the banking side of it. So therefore, this cracked in today's date. But I'm sure the way banks like many of ours are progressing towards, it may be not very far away when you will get a, maybe a 25 lakh rupee SMS per year. Yeah. So that's one. So continuing from there, the data content that is flowing in is, like I said, there are multiple, and he also touched upon it. is there are multiple alternate variables which are today available to garner that data, and especially companies like, large, e-commerce, m-commerce companies who have gathered a lot of information around a customer's actual transactions. So while Google has search, these companies have actual experience data. I mean, वो खरीदता है वहां जाके, correct? So that information is very potent information, and this kind of information flowing into the system in some format, which does not circumvent the privacy law, is actually giving so much of hope in terms of the quality of underwriting that can happen in the digital environment. And I'm sure he will speak more about it, more specific. But that is where the entire width is coming in terms of lendable population. The lendable population is increasing because I have this information of the guy going and doing e-commerce transactions in a particular space, and he's buying a certain type of product from that space. Similarly, he doing other types of conversations somewhere, which is again digital footprint, which is coming into his profile flow in some way. So the more such data emerges, the more this kind of models will become more potent. And yeah, NPA is a part of life actually in the lending scenario. So that
Sure.
will keep evolving.
Sure. Devendra?
So I do feel that it's, of course, gathering data is, we are far ahead as banks, I think, even NBFC for that matter, from where we were 5 years back. And we say garbage in, garbage out, right? So if you're not able to get the important information captured in the application form, then of course you may have the world's best scientists with you, sitting with you can't do much. So there's a lot of emphasis and also investments on the capture rate of data, the quality of data. In fact, most of the organizations now have this data quality and data governance set up. We started almost 2 years back, and we are taking it very, very seriously by bringing in a currency to the data quality. Okay, so first is to ensure that the quality of data is good. Second is, of course, to utilize. Now, while I think I spoke about this whole pyramid where I said that, okay, 60% you've got good data, etc., and 40% is where you rely. While we do partner outside with, of course, consent and without getting into customer details, but more of an inferential data from partners to enrich, I do feel that still the bigger pie is not exactly the IT metadata, but I would say the intelligence part of data. So there's a lot of customers who are sitting with you who are not giving you obvious information in the form of probably the loan that they are keeping with you or the deposits. But there's a lot of hidden data in the micro transactions. We have seen almost 100% growth in our transactions in last 1 year thanks to UPI. I'm sure that's true with all financial organizations. Now, with 100% more data which has flown to you in last 1 year, in minute details of 100 rupees transaction, 300 rupees transaction, 21 rupees transaction, there's a lot of intelligent information sitting right there, and that is a critical mass where I think that as a financial organization, we need to crack that. And I think our incremental growth is also to a great extent coming from that, harnessing that. The challenge, of course, is with the latter part, which is the 30-40%, whether you neither have this nor that, what do you do about it? And that's where you partner out. So far, experience has been that you don't get much out of that because these are anyways new to credit people, and they don't have much history, and also they're not transacting too much outside. So the core growth engine is actually the middle part, and also loads of experimentations are required to keep NPA in control, that I must explicitly state. While it's very glamorous to expand everything and eventually dole out loans, you need to very cautiously curate that experimental pod which serves for the future growth. Maybe 8 to 10% or maybe 5% of your entire growth pool, the lending pool can come from that, and that feeds to the remaining 90.
Okay. detailed one, Devendra, and I think you also mentioned really valid points there. So, Mayuresh, let me come back to you and tell us more about how actually data and AI helps you, in fact, to craft a sustainable lending model. I know that a lot of fintech companies collect data from various sources. Most of them will perhaps know that I'm a poor journalist, can't afford a international holidays by looking at my data, but maybe I go here and there and eat, or watch movies. I think these are the data points which they show. So how, do you make your business decisions or your credit decisions looking at my data? How do you craft your strategy also that, okay, these are the refined data, these are the accurate data?
I think, as other speakers have mentioned, right, the quality of data is very important. Otherwise, it is garbage in, garbage out, right? You can have a lot of data, it'll make no sense. The second thing is around, how you model that data and how you test and learn, right? Yes, I do know that you order from Swiggy, you order from Zomato, you like biryani more so on Wednesdays, but is that really relevant to giving you a personal loan? Maybe, may not be, right? So, like I said, you can get a lot of data, but how much is relevant versus not? And you train your models over time and they learn over time, right? The model keeps getting better every single day, all right? And you have to be willing to take a little risk, right? You will go out and land on a new model. Perhaps on that sub-segment, you will get higher NPS or it won't. And it's about rapid testing, rapid evolution, right? What works, you scale up. What doesn't work, you kill it fast, right? So we always have this kind of a champion portfolio, a challenger portfolio, where the challenger is always trying to do something different, using perhaps a different data source or looking at the same data differently also, right? And we race those models effectively, and whichever wins becomes your new champion. And then there will be a new challenger, a couple of months down the line, trying to beat your current best models. And that's how it evolves. I mean, there is while it may sound simple enough, in reality there's a lot of number crunching which goes into it. There's a lot of analysis, and you learn from experimentation.
Okay. So, Prasanna, what is it that the lenders are actually looking at it when they want to build their data and AI model specifically for lending? And what is the major challenge that you see? Because unfortunately, we do not have any privacy law like GDPR, but let's hope that we'll have something like that. Or maybe you never know, but central bank will come with some guidelines on protecting data going ahead. So how do you look at it? Because considering providing or maybe sufficing the needs of the banks and giving them innovations, how do you match these both?
Yeah, I think the point you just made about the speed of learning is probably a critical one. Like if you look at what happens is, previously you were making these models once every 6 months. You're looking at what does your next year's forecast look like, and you're kind of going down that path. Now you need to be at a much faster. That speed of learning needs to be much faster. And I think that that requires a cultural change. That requires technical change. That requires, from a business perspective, the willingness to be wrong, right? Like the experimental mindset that you just talked about. You want to be better tomorrow than you are today, and I think that way of thinking is imperative from lenders, and I think that is happening, and we are seeing that across the industry in India. The cycle time of improving a decision is not nearly, I don't think any of the major banks have improved their underwriting since the time this session started to now, whereas the startups may have done that, right? So I think that pace isn't where it can be, but I think that change has started, and I think that will have an impact, because in the previous session we talked about a mathematical formula, F equal to ma. So part of that is the A, right, the acceleration. But there's another mathematical formula that I think this audience will be very familiar with. It's about compounding. And so when you're able to be that 0.01% better every day, I think that compounds, and the effect of that is much higher than what you would think.
Okay. Correct. So I have one very important question now, since we are using data AI. Credit is a new, what you can say, a very strong segment now for the fintechs, and obviously for banks it was always there. The RBI is also talking about banks and co-lending model for NBFCs together, so that the credit can be pushed more significantly in the market. So we can see a lot of developments on the credit side. But again, when we look at credit, the important or integral part is the collection, right? So my question to you, and I will start with you, Mr. Bhattacharjee, is, have we reached to a level where that data and AI will help us as in the bankers or the lenders, to tell us that, one, the collection strategy will be really good here, there won't be any issues with the collection. And second, we will actually stop Vijay Mallya from flying. I mean, the next Vijay Mallya, whoever is there, or if you have an example of you already stopped some Vijay Mallya from flying away.
So I don't know whether I can answer the second part of the question in that format, but yeah, I'll try. So, see, again, going back to, how the model is learning is something which is important. And with the variables which are available today and the visibility of these variables and the time of processing these variables to create, early warning visibility of any loan going good or bad is something which is actually evolving. And of course, we use quite a few of them in today's date. But let me take you to two parts of the question that you've asked. One is, retail loans, okay, where you have high volume, small ticket, and very high velocity also. So that's a very different take in terms of model and collection. And the other one is the larger corporate loans, which is the Vijay Mallya types. Now, that's a different take completely. That is where the entire early warning signal comes in a very, very different way, where your assessment of the portfolio of the customer across macroeconomic factors as well as the local industry as well as the his own operation details is very critical, and the industry statistics is also very critical. However, in the retail side of it, where the volumes are increasing, and right in my first comment I had mentioned distribution. What is digital aiding also? The second part of it is the distribution of such retail loans. And the more seamless the onboarding experience, the higher is the offtake of these loans, right? I mean, we have lazy pay in the panel itself, right? So it is so simple to actually onboard onto a lazy pay, loan per se. Obviously, he gives an offer to a person where he's done some assessment behind. So that's definitely there. But having said that, are we sure that that person will give back the money? We will have that percentage of accuracy out there in terms of taking. But that percentage of accuracy is actually coming from the fact that the model has learned so much about that person in that way, and that therefore that accuracy is so much more perfect. Now the other side of it. Now, while that was an example that I took, now imagine personal loans being disbursed through a digital model. Okay. The point is the entire economics of that balance sheet depends on the cost of collection. Correct? Now, if that cost of collection is not reduced in a particular way, I cannot expand that balance sheet in any form. And that's a reality of any lender. Now, if I have to improve that, I need that more and more information about that individual to judge whether that will go wrong at what point of time, and therefore take actions accordingly. Most of our collections earlier used to be reactive. Today, some bit of it can be proactive. I'm not talking about the small ticket BNPLs. I'm talking about the regular personal loan kind of tickets. Now, there we can be, some part of it can be proactive, but at the end of the day, collections is also defined in a particular way and quite regulated and prescriptive in nature in today's date. So that's also another part to the entire piece. But if you ask me, we are maybe 50-50 there in terms of solving some bit of the collections problem. We are still not there completely.
Sure. Devendra?
See, collections, I think I'll agree with Topendra on the proactive and the reactive part. So I do feel that reactive is where most of the banks and financial institutes have kind of championed to a certain extent, which is all about who do we allocate, Okay, when do you settle, and skip tracing. I think these are the very well-known concepts which helps you get the maximum back from the book which is likely to go bad. And of course, heavy use of data science there, very sophisticated predictive models are used there. But I would say, given that the focus right now is digital lending, and the growth of digital lending is also coming from the non-customers. The future growth is going to come more from the non-customers. That's where I do feel that a proactive step to identify customers so that you have lesser pain in the collection stage is extremely important. And even within that, coming back to the part that Topendra touched upon, the BNPL or the small ticket loans, there, of course, somewhere you also take a call that whether the cost of that risk is adjusted in the pricing. Correct. So you eventually, no collection model will work there. It has to be part of the risk-based pricing. And then the middle tier, which is where you have individuals, but you have the time, money, energy to put a collection intelligence around. That's where I think proactive works a lot. Proactive means that you figure out what is the likelihood that the identity is wrong. What is the likelihood that the customer is going to change the address, or the address is not proper. A lot of intelligence, information is available with you. Alternate information is available with you. If you happen to be a customer, your mobile banking allows you a lot of information about tracing the customer in case you see a lot of movement. Your ATM transaction also allows you a lot of information. So I do feel that proactive is going to work big time for collections. Reactive, of course, as we go along, will not be the differentiated proposition.
Sure. Mayuresh?
Largely agree with what Devendra said. More than proactive, it's actually comes down to how you underwrite, right? You don't want to be giving out loans on which you're going to go out and have to collect. All right. So therefore, fraud prevention, again, using data analytics becomes very, very important. I'll just take another example, picking up from the bank statement thing again. Right. We now have millions of bank statements, which we have seen in the past, obviously with due customer consent. Now, what is the probability that you will get another statement in which another 3 transactions are exactly the same as somebody else? Is it possible that some person went to Starbucks, then did a swipe on Amazon, and then did a UPI transaction paying the same person? Is it even possible? That's clearly either the first person is a fraud or the second person is a fraud, but you have some issue there, right? So our systems pick that up. Obviously, the second loan will not go through, and the first loan is therefore sent to collection saying, please check, right? So that's what you can do with data AI, and that again reduces your collections. Apart from that, obviously, I mean, the reactive collections, I don't think a fintech can be very different from a bank. Right. In that sense. It is still pretty much the same.
Sure. So Prasanna, after listening to lenders' view, what do you think? Are you confident about collection on whatever the technology has you're working on or otherwise?
I would say securitize, get it off your balance sheet, make it somebody else's problem.
Okay, that's quite interesting. Yeah. So noted your points. Thanks, Prasanna, and thank you, Devendra, Mayuresh, and Mr. Bhattacharjee for sharing insights here, specifically on the credit and digital lending. And thank you, ladies and gentlemen, for listening to us very, very patiently. Thank you so much.